Brazil, a nation known for its vibrant culture and economic potential, finds itself grappling with a formidable challenge, a deepening economic crisis. At the heart of this crisis lie two interconnected issues: soaring interest rates and a burgeoning national debt. These twin threats cast a long shadow over Brazil's economy, raising concerns about its short-term stability and long-term prospects. The situation in Brazil serves as a stark reminder of the delicate balance that governments must strike in managing their economies. When this balance is disrupted, the consequences can be far-reaching, impacting businesses, consumers, and the overall health of the nation. The crisis in Brazil is a complex issue with no easy solutions. However, understanding the factors at play is crucial for policymakers, investors, and anyone concerned about the future of this important emerging market. In an attempt to rein in rampant inflation, Brazil's central bank has implemented a policy of high interest rates. The benchmark interest rate, a key lever controlling the cost of borrowing, currently stands at a staggering 13.75%. While designed to curb inflation, this policy has come at a steep price. High interest rates act as a double-edged sword. They discourage borrowing and spending, thereby cooling down an overheated economy. On the other hand, they make it more expensive for businesses to invest and expand, ultimately hindering economic growth. For the average Brazilian, high interest rates translate into higher costs for mortgages, car loans, and credit card debt. This reduces consumer purchasing power and further dampens economic activity. The construction industry, a significant driver of economic growth, has been particularly hard hit, as high mortgage rates make homeownership unattainable for many Brazilians. Adding to Brazil's economic woes is a rapidly growing national debt. The country's debt-to-GDP ratio, a key indicator of economic health, has reached a worrisome 92%. This means that Brazil owes almost as much as it produces in a year, a precarious position that raises alarm bells among economists and investors. Several factors have contributed to Brazil's burgeoning debt. Persistent government deficits, where spending outpaces revenue, have played a significant role. Additionally, the high interest rates implemented to combat inflation have increased the cost of servicing existing debt, further exacerbating the problem. Brazil's debt is not only a domestic concern. A significant portion of its debt is held by foreign investors. This external debt exposes Brazil to risks associated with currency fluctuations and changes in global interest rates. As the Brazilian real depreciates against major currencies like the US dollar, servicing this external debt becomes increasingly burdensome. Section 4. Government on the brink. The confluence of high interest rates and a mounting debt burden has placed immense pressure on Brazil's government. Debt repayments now consume a significant portion of government revenue, leaving fewer resources available for essential public services such as healthcare, education, and infrastructure. Faced with this fiscal straitjacket, the government has resorted to austerity measures, including cuts to public spending and social programs. While these measures are intended to reduce the deficit and rein in debt, they have sparked public discontent and fueled social unrest. The government's ability to navigate this crisis is further hampered by limited fiscal policy flexibility. The need to balance the budget while addressing pressing social needs presents a formidable challenge. Failure to find a sustainable solution could have dire consequences for Brazil's economic and social stability. Section 5. The people feel the squeeze. The impact of Brazil's economic crisis is acutely felt by its citizens. Despite the central bank's efforts, inflation remains stubbornly high, eroding purchasing power and increasing the cost of living. The price of basic necessities, such as food and fuel, continues to rise, placing a strain on household budgets. The high interest rates, while intended to curb inflation, have had the unintended consequence of stifling economic growth and job creation. Unemployment remains stubbornly high, particularly among young people. This lack of opportunity breeds uncertainty and frustration, further eroding public confidence in the government's ability to manage the crisis. The economic turmoil has also led to a decline in living standards for many Brazilians. Access to healthcare and education is increasingly strained, jeopardizing the well-being of current and future generations. The social safety net, already fragile, is stretched thin, leaving many vulnerable citizens without adequate support. Section 6. A glimmer of hope. Amidst the gloom, there are some glimmers of hope for Brazil's economy. The country possesses vast natural resources, a diverse industrial base, and a young and growing population. These factors provide a foundation for future growth, provided the current challenges can be addressed effectively. Brazil has also made some progress in recent years in diversifying its economy and expanding its trade relationships. The country has benefited from increased trade with China and other emerging markets. Further integration into the global economy could provide a much-needed boost to exports and attract foreign investment. However, realizing this potential requires decisive action from policymakers. Addressing the structural issues that have plagued Brazil's economy for decades, such as bureaucratic inefficiency, corruption, and inequality, is crucial for achieving sustainable and inclusive growth. Section 7. Navigating the storm. Brazil's economic crisis presents a formidable challenge, but it is not insurmountable. Successfully navigating this storm requires a multi-pronged approach that addresses both the immediate symptoms and the underlying causes of the crisis. First and foremost, taming inflation must remain a top priority. Bringing inflation under control will require a delicate balancing act, carefully calibrating interest rates to curb price increases without stifling economic activity. This will require close coordination between the central bank and the government. Second, addressing the growing debt burden is crucial. This will require a combination of measures, including fiscal discipline, structural reforms to boost economic growth, and potentially debt restructuring negotiations with creditors. Painful choices will need to be made, but putting Brazil's fiscal house in order is essential for restoring investor confidence and securing long-term economic stability. Finally, Brazil must address the social consequences of the crisis. Investing in education, healthcare, and social safety nets will be crucial for mitigating the impact on the most vulnerable segments of society. Creating an environment that fosters job creation and entrepreneurship will be essential for ensuring that the benefits of economic growth are shared more broadly. Brazil's economic future hangs in the balance. The choices made today will determine whether the country emerges from this crisis stronger and more resilient, or succumbs to the weight of its economic woes. The world is watching, hoping that Brazil will once again realize its vast potential. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.